funsupermart.com.
Hi, do you see any trends in terms of debt and equity flows in the last quarter?
Yes, certainly. We saw a very dramatic reversal in the middle of last year with the Fragile Five and taper fears, and the money that had started to go into emerging market equities reversed, led by even sharper falls in inflows into emerging market debt. And sentiment remained quite negative probably until around March of this year. And since then, we've seen an encouraging reversal. We've seen money coming in gradually into both the emerging equity and debt space, although so far it's early days and it's still in relatively moderate amounts. In Asia, for example, we've seen inflows into India, into Taiwan, Korea, Indonesia. In fact, the only Asian country with a slight outflow was Thailand, and I think that's probably attributable to the political problems there. So it's looking like sentiment towards the emerging markets became too negative, and now we're seeing money moving back into this region.
How then should investors position their portfolio in light of benign inflation and impending rising rates?
Well, yes, impending rising rates, but as you say, inflation is still benign, and there's absolutely no sign that inflation is going to become a major problem soon. So I think the first advice to investors is don't really fear the Fed at this point in time. The Fed is simply going to start to normalize policy, which is good because it means that in their view the US economy is normalizing and becoming stronger. So don't just look at rising interest rates. Probably people will worry a little bit about the Fed. It might introduce more volatility in the market in the next 6 months than we had in the first 6 months of the year. But the underlying global economy is still pretty healthy, even if the IMF has recently revised down its global GDP growth forecast for this year from 3.7 to 3.4%. 3.4 is still pretty strong, still better than last year, so investors should stay focused on equity markets. They need to be in the market, not out of the market at this point in time.
Emerging markets are spotting more attractive valuations than developed markets. What do you think will influence the way emerging markets move in the next 1 to 2 years?
I think it's going to be a question of earnings, earnings, and earnings. It's a question of show me the money. Emerging markets have underperformed, and rightly so, because earnings have disappointed, return on equity has disappointed. But this has been because of cyclical problems, because their export markets have suffered greatly because of the second recession, the double whammy in Europe, and because of fairly moderate import demand in the US, even set against a moderate recovery there. We can now see signs that Asian exports are starting to pick up, particularly for the Northeast Asia globally leveraged economies like China, Korea, and Taiwan. And so this augurs well for Asian export earnings. Once we see that inflection point in earnings, then I think investors will come back to the asset class. So the advice would be to position early, don't leave it too late.